Welcome at yet another podcast on the Euro stablecoin group of the Two Tokens Foundation, where we update you on the progress of our work group with regards to Euro tokens. I'm sitting here together with my co-captain of the work group, Dion Bongaerts. My name is Olivier Rikken, and for the past half years we've been starting this work group so far, and we want to give you a update on the stablecoin work group in itself. Why is a work group like this even necessary? What is the status so far? What do we have been doing? And where are we going? And also a call to action. So welcome once again, and welcome Dion. Great to have you again.
Thank you, Olivier.
So half year down the road, a lot of things happened in stablecoin land, but we're going to talk
You
about
can
that.
say that again.
Yeah, absolutely. But we're going to elaborate on that a little bit more later on. But just the first question, why a stablecoin, and especially why a Euro stablecoin? What is the need for it?
Well, at Two Tokens, we have been developing several business cases for using tokens for business purposes. And for example, I myself have been involved in the invoice markets work group. And what we noticed there, and also in other work groups, was that having tokenized money would be really, really useful, because people like tokenized money. It has a stable value. It's what they are used to transact in. That's also one of the properties that typical money has: a stable value, a storage of value, if you want. And in the US, you have stable coins. You also see them being used quite a lot. They're very popular. This indicates a need or demand for them. But in the Euro area, you hardly see them. The few Euro stable coins that are there are very, very small.
So there is a clear need for stablecoins, especially to gain efficiency in other tokenized projects in itself.
As a payments infrastructure.
Yeah.
As an alternative for the standard payment infrastructure that we now have, which involves banks and central banks.
Yeah, and especially if you take into account that if you do the transfer of ownership of assets that are tokenized on one hand, and you integrate the transfer of the payment and the settlement of the payment within the same transaction, this is where the potential true efficiency gain will be, right?
Yeah, exactly. Because what you can do then is that you can have instant settlement of transactions. So the tokenized assets and the tokenized money change hands at exactly the same time. And that is something that you really want to have in a decentralized system where people don't necessarily trust one another, where you don't have a trusted party that basically ensures that the other party will also pay up.
Yeah, and currently in the current payment system, this is only possible with paper money, I would say. So this direct transaction is only possible with paper money, because once it goes digital, there's always a delay.
There's always a delay. But fortunately, we have parties like banks and central banks that kind of ensure that these transactions will go through.
Yeah. And if you truly want to do this completely peer-to-peer, that is where it comes in that we need a stable coin, in this case then a Euro stable coin, because the US dollar variant has been out there and growing quite fast lately.
Yes, exactly. But if you consume in euros,
yeah,
and there's exchange rate risk, then you also want to have your revenues in euros.
Absolutely. So there's a clear need for stablecoins and Euro stablecoins in itself. But why do we then need this work group? Because there are some initiatives out there. So why not just blank pick one off the shelf and go with it?
Well, in Europe they don't really take off, and we wanted to understand why and whether we could do something about that. So that was the first part of the mission of this working group, to understand the concept of stablecoins, what is needed for a properly functioning stablecoin, what desired or necessary properties are to come up with alternatives, score those alternatives according to these to these properties. And then for the next step, we can work out a few of those candidates and see how they work in practice.
Yeah, because there are so many forms of these stablecoins, although they're all called stablecoins or euro stablecoins in themselves. The build-up is completely different of all the different types of them, and we want to make sure that beside judging if there's a need for euro stablecoins, also that they are regulatory sound and sustainable in multiple ways. Right?
Sustainable in multiple ways. So stability is a very clear requirement for a stablecoin. Otherwise, it wouldn't be a stablecoin. But it's also important that whichever party introduces this stablecoin and provides some necessary services to support that stablecoin can make a business out of it. Mm-hmm. If this is a money-losing operation, then you need to think about, well, does this have perspective? And can we have this to begin with in the long run?
Because if there's one thing that needs a almost perpetual going concern, it's money in itself. We shouldn't be dependent on a company saying, all right, we're bankrupt now, so you cannot access your money as a whole anymore.
Well, for things like money, deposit type of claims, which essentially a stablecoin is, there's something else. The moment people start to doubt the integrity of the system, they will basically run to get their money out.
Yeah,
and that will make the stablecoin collapse in an unorderly fashion.
Yeah, and this is actually quite interesting because we started off with a lot of things happened, and actually one of the bigger stablecoins out there completely collapsed in the last few months.
Exactly.
Being the UST,
Terra
in itself. Can you just elaborate a little bit what happened there for people who don't know what happened to this stablecoin? Because you think it's called a stablecoin, so it's stable, right?
Yes. So in a nutshell, how Terra worked was that there was a promise that Terra would always be worth $1, and in case not, you would essentially get incentives for people to buy Terra in exchange for other coins that essentially had the value of the Terra ecosystem as a pot of money behind it. Mm-hmm. So as long as there was sufficient value in that Terra ecosystem, at least people believed there was sufficient value in the Terra ecosystem, you could sustain that. It's the same way as central banks support their currency when their currency devaluates too much. They buy more of it in exchange for other currencies.
And with Terra, they depended on the ecosystem as a whole to basically be this stabilizing mechanism.
Yes. So and the value of that ecosystem was monetized in the Luna token. That was the companion token for Terra. Now, the Federal Reserve increased interest rates. Because of that, the whole crypto sector became less interesting for investors. Mm-hmm. One reason we saw such a boom in the crypto sector has been the extremely low rates by central banks worldwide. So you saw an enormous outflow out of that system, and therefore also a reduction in value of that.
Yeah. But not only in Terra and Luna, but in the system as a whole, right?
In the system as a whole. Yeah. In the system as a whole. So once you get these outflows, there's pressure on both Terra as well as on Luna. Because of the stabilization trades, you get even more pressure on Luna. It takes off pressure from Terra, but it puts on extra pressure on Luna. People may start to doubt the integrity or the value, long-term value of that system, and out of precaution get out, some people may try to manipulate this by predatory trading, putting further pressure on this, and then you can get a complete collapse.
Yeah, and this stabilizing mechanism sometimes also is called algorithmic trading stabilizing mechanism in itself. Yes. It is one of the scenarios we looked at for a euro stable coin, right? Because if going back to the process that we wanted to go through was set up a whole range of scenarios based on various characteristics, and one of the stabilizing characteristics could be algorithmic trading. Exactly. And it is actually quite interesting that we all said, well, we need to mention the algorithmic trading stability mechanism, but it's never going to fly from a regulatory point of view because we cannot foresee all the black swan scenarios and
yeah, from a regulatory point of view, but also from really a stability point of view, because whatever you have as backing there is going to be volatile. Yeah. And whenever you have that the backing of a stable coin is volatile, you run the risk of a disorderly liquidation, like very similar to a bank run. Yeah. So the only way to fully prevent that is to have cash as your pot of money to ensure value, and even that can be stolen. Yeah. Or to have a government guarantee.
So there are multiple ways to deal with it, and that's also one of the pillars that we actually looked at.
Exactly.
Right? Because, like we said, we were going to set up a series of scenarios based on various characteristics, and we had 5 main categories of characteristics. One being, is it financially sound? Is it regulatory sound? Is it operational possible to work with it? Various technical aspects, but also from a functional or ecosystem point of view, will be used by a lot of people, or do we have a very organic grow mechanism and then nobody will use it in the end? So these were the 5 mechanisms that where we looked at, and the stability mechanism obviously was one of the, is it financially sound, how is it backed, etc.
Exactly.
And like we said, algorithmic trading was one of them, and we discussed that up front, said, well, it's never going to fly. And then the whole Terra incident happened. And what always makes me wonder, why does the industry, or why did the industry think it was such a good idea to have a system like this? It's the $1 million question, or the $8 billion question.
So I think one of the appeals of the algorithmic stablecoin was the community sense. There have been other algorithmic stablecoins that also collapsed. Terra was kind of the exception. That's also why it attracted relatively many true believers in decentralization. If you look at most of the other alternatives, those involve more centralized parties. If you look at USDT, there is one party that administers a pot of money as collateral about which they're very intransparent, and they let audit by an accountant on the Bahamas or so.
Yeah, because USDT is quite controversial in itself as well. Yeah. While being the biggest still out there, or not?
To the best of my recollection, yes. And there, the doubt again comes from the fact that the collateral, the pot of securities and money behind it, is volatile in value. So if it drops by too much, you will again get this run to the exit, disorderly liquidation.
Yeah. So all these things you are saying, actually, this stabilizing mechanism and making sure that people trust that it will always be backed by sufficient funds in the background, whatever the funds are. That is something that we saw coming back in rating our scenarios as well as being very, very important. And thus, if you want to set up a sustainable euro stablecoin that is future-proof, this is something that should be really, really sound.
Exactly. That is the basis. That's the most, I think, the most important criterion. Yeah. The second is probably, can you run a business model off it?
Yeah, and do not underestimate, is it allowed to under regulation, etc.
Obviously.
And especially with upcoming regulations in Europe, they're going to be very strict on stable coins in this case.
Yes. There's only a few ways in which you could do it. You could do it under an e-money license, and then you experience a lot of restrictions. The alternative would be to do it as a bank. Then it would fall under your regular banking license. But you would have scrutiny with respect to money laundering procedure and anti-money laundering.
But let's elaborate on the regulatory side and the effect of MiCA in this case on stablecoins for another podcast, because I think we can fill up a whole range of podcasts on that topic in itself. So what we have been doing in the past few months, sit down with a wide group of people thinking about all these various scenarios. So first, within these 5 categories, financial, regulatory, operational, technical, and functional, we came up with sub-characteristics. And out of these sub-characteristics, we start to basically form scenarios. So we ended up with a total of 9 scenarios.
9 scenarios, yes. Out of which we picked 3 that were our prime picks. So basically what we did there is these scenarios, we said, okay, they're all a mix of match of various financial systems or regulatory soundness or operational and technical functionality possibilities and functional possibilities, etc. So like a good scenario planning exercise, we all named them and we said, okay, now we're going to actually rate them. So what we did there is we started rating them and also started to attach weight to ratings. It is a sound process, but there's always a little bit of subjectivity in it, right? That is the downside of this way of working. These weights are to a certain degree arbitrary.
Yeah. And for anybody who wants to read more about this process and the weights and the characteristics that we use, we are working on a little let's call it a white paper, where we describe how we came up with these scenarios in itself. So like you said, we had 9 scenarios, we all weighted them, and based on these weights, we created a weighted score, obviously. And just by heart, it is, say around, and now I have to count very quickly, it was 20 criteria in the end that came up with a weighted score in itself. And there were 3 scenarios where, based on the weighted score, we as a group deemed these are the most feasible to further investigate, to see if we can start experimenting with these stablecoins in itself. And these were the banking retailing scenario, the banking wholesale scenario, and the public-private scenario. And maybe you want to just briefly touch upon these 3 scenarios, what they entail?
Yeah, sure. So the banking retail scenario is a scenario in which stable coins are issued by banks. Because they're issued by banks, they have bank balance sheets as collateral. That means that they're basically as safe as other deposit claims that we have, and that they can also be protected under deposit insurance, which is an enormous additional stabilizer.
Yeah, because this insurance part is typically something we set with a group. This is a backfall or fallback in case it goes completely south. So
exactly. So how this works, at least in the Netherlands, is that banks co-insure each other through an insurance fund, and then the government as a backstop. So this is basically as safe as your bank deposits up to 100K. with a commercial bank. Now, it also allows, because of this structure, to be backed by somewhat riskier assets than just cash. Anything that's on the bank balance sheet can, in principle, be backing. And that also allows for an earnings model from the bank, an asset earnings model.
Yeah, and that could make it more sustainable from a business model perspective.
From a business model perspective. You could still also get transaction fees or a subscription fee with that. But if the collateral assets generate enough returns, especially when interest rates are a bit higher, that need not even be necessary.
Yeah, because this business model is something that should not be underestimated, right?
Yeah.
It's one of the things a lot of stable coins struggle with at the moment.
Yeah,
especially
especially in low rate environments.
Yeah.
Because then if you put very safe assets such as short-term government bonds as collateral, they don't earn enough to cover your cost for technology and people, etc. Simply your operational costs.
Yeah. So the banking part, and we split it in two: the retail and the wholesale. Well, that's bread and butter for you, but maybe the difference for.
So the idea for the retail part would really that this is for consumers, for people like you and me, for everyday transactions, small services, provide the convenience to get large user bases to apps that work with tokens. The wholesale part is more for larger businesses to do mutual transactions. This is typically involving large amounts of money that would fall outside of the deposit insurance system, where also risks for example, money laundering may be higher because larger sums are involved. Often more international transactions are involved. So you also would need a slightly different structure.
Yeah, it's a different structure, but also potentially different regulatory regime, because on the one hand, there is a higher risk on money laundering, cross-border payments, etc. On the other hand, it's not consumer facing, so the consumer protection is not
is less severe.
It's less there. So it can have influence on a lot of elements in this case, right? And the third one was a public-private scenario.
Yes, that is rather similar to the banking retail model, in the sense that also the government would provide an insurance. Because of this government insurance, there could be slightly higher risky assets as collateral than just cash.
Although we set for the deposit that we want to have it as much fiat backed as possible.
Yeah.
And especially the government backing would be on the business model in itself, to make sure that it can always run.
Yes, exactly. Because then, rather than having to live off asset earnings, you could, for example, have it financed by taxes and potentially supplemented with a user transaction fee.
Yeah, and in this case, we have the possibility to have a long-term sustainable business model, so the system as a whole keeps on running, because you want it to keep on running, but also have the certainty that through a very, very high rate of fiat backing, that there is always a stability towards the outstanding amount.
Yeah. Well, with something like this, you would, even if you don't provide the explicit insurance, you would always have the expectation of insurance. Because it's government sponsored, that would also help. One other reason why you want as much fiat as possible is that you don't want to have the taxpayers on the hook for asset mismanagement.
Yeah, absolutely. All right, so these are the three scenarios. So what are the steps that we are now looking at is really looking into current initiatives, because we can think that we can come up with all the scenarios and the best euro stablecoins in the world, but obviously there are more out there. One particularly interesting that is coming up right now, the EUROC in itself. It's the euro variant of the USDC. But there are probably many more euro stablecoin initiatives out there. Where we want to compare these scenarios towards what they are doing and to see where are the differences, etc. So we can learn from that.
And also going forward, I also expect that more euro stable coins will be coming up as interest rates in euro area are not negative anymore, so it becomes slightly easier.
Yeah, also from this business model perspective.
From this business model perspective to get it to run.
Yeah. So and that is immediately also a call to action. Obviously, is if you know people that are involved in these kind of initiatives, or you are a person involved in these kind of initiatives, please contact us so we can compare your initiative towards the scenarios that we are looking at, and also from first from a perspective so we can learn from each other to see where is a overlap, where are differences, why are those differences there. But secondly, also if there is a high overlap, potentially we can work together to really test these tokens in various scenarios to really, and now we're really going back to where we started with this podcast actually, to see how much these efficiency gains actually are if we are using them in a tokenized environment in itself.
Exactly. Yeah. Even if this is a test net type of version where that's all kind of MVPs can use through a standard smart contract or API.
Yeah, and all in order to help to basically the token ecosystem much further.
Exactly.
At this point in time. So given the time, we're almost running towards half an hour podcast already. So far, we've worked on the various scenarios. We are now at the point that we're comparing the preferred scenarios to existing initiatives and also see if there's a match, yes or no, to take these stablecoins to test them or maybe set them up themselves. Although I personally always am a fan of reusing what there is already. And then test it as much in practice to see the efficiency gain as a whole. So any other considerations from your side at this point in time, or
at this point not?
At this point not. No. So they're really the ball is in our ballpark at the moment that we have to work on this one. And again, a call to action to everybody who listens to this podcast. If you know somebody in these kind of initiatives, don't hesitate to contact the Two Tokens Foundation and the Euro Stablecoin Work Group, because we're very, very interested in talking to those initiatives to see how we can help each other really putting this into practice, and with that also convincing governments and central banks in the added value of these kind of euro stablecoins, and going beyond the fact that anything crypto related is scary, but can also have huge efficiency gains if set up correctly with a regulatory and a financial and business model sustainability in background, right?
Exactly.
Absolutely. All right, so this was the Update Stablecoin podcast for today. We will hopefully give you an update in a few months down the road, or even quicker than that. As soon as we have the white paper with regards to the process so far ready, we will let you know through the websites of the Two Tokens Foundation. And do not forget to subscribe on the podcast, because we're not only talking stablecoins, we're talking a whole wide range of very interesting tokenization topics on the Two Tokens Foundation podcast series. So please don't forget to subscribe. Thank you very much for listening. And again, if you have any contacts in the stablecoin world, we're very happy to get in contact with those initiatives so we can learn from each other and bring the ecosystem further. Thank you very much for now and hope to hear you soon again.
That was it for today's podcast. Thank you for listening in and please subscribe so you don't miss out on our upcoming episodes. If you want to get in touch with us, you can find our contact details at www.twotokens.org.